Hi everyone, welcome to this Fonterra Sky broadcast. It's great to have you with us. Today we're going to be discussing the interim results, and here to discuss those results with us today, Chairman of Fonterra, John Wilson. Hey John.
Scotty, how are you?
CEO Theo Spierings, nice to see you, Theo.
Hi Scotty.
Our CFO Lukas, Paravicini.
Good evening, Scotty.
How you going, mate? And Ian Brown, the Chairman of the Shareholders Council. Gentlemen, let's start with this. John, Cyclone Lucy, not the punch some farmers would have wanted, but how's it looking out there conditions-wise?
Well, we certainly missed the punch where I farm, so it's still very dry where I am, but some parts of New Zealand certainly got that rain, but the middle of the Waikato is still really, really dry and under pressure. I think Ian might have got a bit more than me, but...
Yeah, we profited. We did get a bit more than John, but as John said, really variable, but really on the back of a very good season to date, so it's going to have an impact, but we've had a very good first half of the year.
Yeah, well, let's talk about that, John, because a very good result, and despite the weather, a good start to the season.
It's been a very good start to the season, good start to the year. I mean, we're well through it now, but for the first half of the year, about 1.12 billion kilograms of milk solids produced, about 4%, just 4.5% up on last year.
So we started off with record milk collection in New Zealand, and we're on track now to deliver highest ever returns.
Yeah, it's a very good, looking like a very good year for our Fonterra farmers. So our milk price forecast currently, $8.65 per kilo of milk solids, and we are holding our forecast dividend at 10 cents, so a total payout forecast at the moment of $8.75. And of course that's about $2.50, $2.60 up on last year, so good news for our rural communities.
Look, Theo, I want to bring you in here, because can you talk to us, what is driving this record forecast?
I think since the beginning of the season, what you really saw happening is that the multiple supply issues around the world of even last season, but also during this season, so there were really supply issues all around, and demand really stayed strong. So with a strong demand and some supply issues around, that means that the prices are going to go up. So we saw really that trend throughout the whole of the first half. So that's why you see our turnover has lifted by 21%. So that's quite significant. Yeah, this is really big income for the country and economic growth. So that's really our top line. But what you see at the same time is that because input prices, milk price is high, so cost is high. So margins are under pressure, but that's a timing effect. So we really say to our people, price what the market can bear. But that means that for a certain period of time you're under a margin pressure, and that has happened the first half. So turnover really 21% up, EBIT to a level of 403 million, and net profit to 217 million, which is under pressure. It's lower than the year before, but we are saying price what the market can bear. Make sure that you keep demand going, that you see volume growth around the world, and that you really increase your market share.
Volatility is a word you've used before plenty of times. It's still a factor, isn't it, in dairy?
Yeah, volatility is there, and is there to stay. I mean, for many years when there was heavy support, especially in Europe, you saw very, very stable prices for a very long period of time, even 20, 30 years. But after 2007, it really started to fluctuate, and you see high volatility. I mean, this time when we came out, or when we were in the middle of the drought, you saw the prices going really to exceptional height. Mm-hmm. Do I think that that's going to happen every year? No, but you will see movements in prices, and that's life, and we have to really live with that and cope with it.
Well, John, we've talked about some margin pressures too in food service and in consumer, but the board is holding on to that 10-cent full-year return, dividend return.
Yes, we are. So our forecast going forward, and I know that Lukas will talk about this shortly, our forecast at the moment is a 10-cent full forecast for the year, and we announced today that we will be making an interim dividend of 5 cents.
I just want to talk about one thing. Back in December, the board made a decision to forecast a farm gate milk price that was 70 cents lower than the price calculated under the milk price manual. Does that 70-cent gap still remain? Yes,
it does still remain today. And I think the first thing that we need to make very clear is the confidence that the board has in the milk price manual and that process. And what it's doing is giving us transparency, which of course we've never had before. Now, if you go back in time, it hadn't been our expectation that we would get ourselves into this position, but the reality is, as Theo's touched on, the extreme volatility has meant that the returns for non-milk price products, which is predominantly casein and cheese, has been so much lower than what our powder returns have been. And the powder returns is what informs that milk price. And so we've got two things going on here. First of all, we've got transparency, absolute faith in the milk price setting process. But Fonterra has a group of assets that we've inherited, that farmers have invested in for many years, and some of those are not those assets that inform the milk price. And approximately 25 to 30% over the peak of our products could not go to milk price products, and that is what that 70-cent gap is.
And without a 70-cent, Scotty, just to add in, really with that gap between milk price products and non-milk price products, you would really face a situation that you would have to pay milk price heavily out of the balance sheet, and even going to pay milk price out of loans. And that is where the board stepped in, or we proposed the board stepped in, and the co-op is protected for short-term volatility. It's not a long-term thing.
Well, Lukas, I'll bring you in here because you've been crunching the numbers. So perhaps from a CFO point of view, you'd like to expand on this 70-cent gap.
Yeah, thank you very much, Scotty. I think we have been talking a lot about protecting the cooperative and staying on strategy. I think it's important that we put figures on the table and explain very in detail what we have actually done. From the chart you can see now, you can see that we have clearly retained $519 million from those 70 cents discounted milk price. That covers a stream return, what John has mentioned before, the product mix impact we had of roughly 560 million. That is the impact we have of a good return on the milk price reference products and a less good impact on the non-milk price reference product. You can see from the chart that that full impact is 560 million. As Theo mentioned before, would we pay out the full milk price at this stage, we would have to borrow money from the bank to actually make that payment. And that is not in the spirit of protecting the cooperative. That's why we have taken the decision to submit to the board a discounted milk price for the time being. You can also see from that chart, and I think it's important to understand, that there is other elements that have impacted the movement from last half year to this half year. The other movement being the peak constraint. This year we had a super flush, we had a record milk supply. That has had impact on our productivity at the factories. It has had impact on how much milk we had to process in the southern island and therefore ship to the southern island. But it also had inevitably problems in terms of disposal of milk, and therefore we have incurred in more cost than the year before in terms of super flush or peak production. The third part is also recognizing that while the high milk price is very good for our farmers, it does have an impact on our consumer brands business. It has an impact on the margins, and therefore you can see in the third box that that has an impact in terms of the Oceania market or region and the Asian region. What I would like to highlight though is that if you look at the three boxes, the biggest impact and the reason we did the discounted milk price is clearly in the first piece related to the milk price calculation and not to the consumer price calculation. That has an impact, but can be supported by the normal course of the business. One last comment I wanted to make on this chart is, you could still ask me, well, yeah, but we still dropped a lot from last year to this year. Remember, with the 70 cents, what we're actually covering is the negative product mix impact of this year. For those who remember, when we were here last year, we said we had a very good first half in 2013. That very first good first half was actually due to the opposite effect of the product mix. So we have roughly 175 million in that first half, 2013, that actually boosted that result. And when you compare one year to the other, it is necessary that you actually consider these two figures.
Lukas, you did mention the word retain there, but this is not a retention in the technical sense, is it?
Scotty, thank you very much for picking up that retention word. It must be my second language issue I have sometimes still. But you're absolutely right. We can't really retain something that we never had. And when we said before we would have to go and borrow money to pay the farmers, it means that we don't have that money. So we actually speak always from a discounted milk price or an adjusted milk price. Because what is really happening is that we have an income on the milk price reference product and not on the non-milk price reference product. So it is not a retention. We never took that money into the company, and therefore we talk about adjustment.
Ian, your thoughts here on from the point of view of the Shareholders Council. Do they support this decision?
Farmers absolutely understand the decision the board made, and they understand very clearly the milk price manual. So really, farmers know that you can't pay out money you don't have. To do so would have put a completely unnecessary strain on the cooperative's balance sheet, and you just clearly wouldn't go there. So if there's an area of concern that farmers do have and have communicated to the council, it's the impact of the decision the board made on the milk price and the effect that has on the EBIT of the NZMP business.
Indeed, when you see now this slide that you have on the screen, what you can clearly see there is we do actually have an EBIT at the end of the half year of 2014. And we have discussed that with the shareholder councils upon their question. And it is true that when we say the adjustment is needed to cover up the product mix impact. But remember, the milk price manual stipulates that the milk price has to cover the raw material, but also the production cost of that milk price. And that includes a cost of capital. So depreciation and the money we have to lend to make that product. Therefore, you will always see an EBIT at the end of the year, because that EBIT is needed for us to make sure that we can actually continue to produce and keep our infrastructure up to speed to be able to continue to do that business. So it is good that we mention that, because I think there's a confusion that when we talk about adjustment, the adjustment is not referred to a zero EBIT limit, but it is referred to the product mix impact. So what we're recovering is the product mix impact, which allows us to have enough EBIT for us to continue to invest in the infrastructure and make sure that we can actually absorb the milk that is supplied and process it into milk products.
And on top of that, milk price is based on what you do on GDT, on the real commodity prices, right? But we sell a lot of volume of GDT where we have price achievement. Yeah? In markets where you have sometimes a higher risk, yeah, we achieve prices above GDT. That price achievement we deliver in markets is going to the EBIT line, but it has nothing to do with the difference between milk price products and non-milk price products on our auction. Right? That's the baseline, and the gap we're closing is on the baseline. But money you make on top of that in certain markets where you create value, yeah, or where the risk is a bit higher and there's a risk premium, that's EBIT.
And I think you make an interesting point there on two aspects. One is that actually we can see from the charts that we have shown so far that we can actually pay the dividend out of our consumer brands business, even though that it has a reduced margin. So it's still enough to pay the dividend. That's one. And I think the other point you made is that there are price achievements. If you look at the chart that we have on the screen, you can see that we have disclosed a bit more on what NZMP does. And you can see that despite the price achievement showing a negative impact from year to year of 5 million, that means still that underlying there's 160 million of price achievement. In an environment of such high milk prices, that is actually an outstanding performance of our salespeople. So I think that is just a good moment to also reflect on that we could achieve that price achievement of 160 million.
And that is back to Scotty's first point, supply and demand. There was scarcity, so people want to secure supply and are willing to pay price premium above GDT, yeah, which is EBIT.
Guys, I want to discuss markets briefly, take the guys into what influences these results. We'll start with four. We've got Asia, Africa, Middle East and China. Lukas, where are we at in these markets? What has influenced the results in these markets?
You'll see on the screens the different slides. But what is important when we look at Oceania right now is that actually you have different impacts here. You have one, which you can clearly see there, that is a negative impact on the brands business. And the brands business is under pressure through input cost, but also, let's be honest, the yogurt category that we are still struggling with. While we have done a lot of improvements, we have streamlined the brands, We have re-engaged with the retailers. The yogurt business is still an area where we have to continue to work on. We have had a positive impact on the ingredients business. As much as that sounds strange with all the happening and the discussions around some of the supply agreements we have, the rationale behind that is actually that last year we had a very bad ingredients year, and we're looking at differences from one year to the other. And to be honest, and what we always have said, the agreements with our suppliers were more on volume based and less on margin based. You can see also from the screen that on New Zealand we have had a negative impact. That is mainly due to significant margin pressure also from the high milk price. There has been also some issues around the SAP launch, but that is minor and it is very much restricted to a 2-3 months window. What I would like to highlight though in NZ, in the New Zealand business, is that we actually have done very well on RD1, and it has increased 11% its EBIT level from one year to the other. So when you go on the next slide, you can see actually the Asian performance. And I think in Asia, we have to be very clearly, we have actually been able to increase the volumes. And that increase is not just 3% as we reported, it actually is 10% if we take away Sri Lanka, which is a specific issue we had. But if you look at that slide, you can see that through the volume we gained a little bit of more margin, but we also did gain 30 million more margin against last year because we pushed prices. Theo was very clear always that we will drive price increases in those markets as much as we can in accordance to the inflation, the food inflation. And you can see a good proof of that in that chart. Having said that though, you know, we have had a negative impact on some of the volume in Sri Lanka specifically, but in general, when you push prices upwards, you will have consumers dropping off the demand because it's just too much. So it's always a fine balance of what we want, just margin security or actually taking the advantage of advancing volume for future benefits. You also can see there the huge impact on the input cost, and that input cost obviously is bigger than what we have been able to pass on to the consumer, as I've discussed before. There's some impact on foreign exchange rates. A lot of that is translation, but it is obviously hitting us in our accounting. We have had some good performance in China, but we also have invested heavily to build up our farming industry. Therefore, you cannot really see that on that chart. But behind that, you have a good performance on the farms itself and the branded business. But we are investing heavily in building even a stronger business in China.
And I think to tap into that all around Asia, emerging markets, it's very, very important that we grow our market share, right? And we have always been growing at market level or possibly even below in the past because we were very much value driven. Now you see all markets have grown faster than the market, right? So we are gaining share, except for Sri Lanka. And just to remind, when we were after the WPC80 issue, we had issues in Sri Lanka as well. We even stopped our operations, and of course that has an enormous impact. And therefore the growth in Sri Lanka has been lower, much lower, or even negative. But all the other markets, including food service, we show double-digit growth, which is really very good. And we increase prices, like Lukas said. But we increased prices to the extent we could.
Good results too out of Latin America, one market we haven't discussed.
Latin America is really year on year. It has been our star performer already for 2-3 years in a row, and they are always able to show volume growth. Although these figures are predominantly driven by Chile. Chile is 16 million people. It's a big country, but not a lot of people. It was a long country, so the growth is single digit, 3-4%. But they're always doing very well on value because they are such an iconic brand in Chile. So it's really a star performer and really well done.
Theo, just let me make one comment to that. I think we're all very excited on the past performance of Soprole and LATAM in general and its potential going forward. And over the last few years, Soprole has consistently delivered a superior performance. On this chart, when you look at the comparison, we look year to year, And we have to recognize that Soprole has done a very good job in actually increasing its prices, which it has been done better because of its iconic value of the brands in Latin America or in Chile. It was helped by that, and therefore the volume when we cut off at January the accounts, has had a negative impact. But on the other side also, we can highlight that on the larger picture of Latin America, we've also been able to actually turn around or stop the bleeding in Venezuela around DPA. It is now a cash positive operation, which is reflected on that chart. And we have actually also done a very good job on the southern corn, especially on the ingredients business, to make it a more profitable business for us, returning a better return this year than it did last year. So overall, Latin America has a very strong presence in Chile with strong brands. DPA is doing better. The ingredients business is doing better. So overall, there is an increase in its performance over last year.
Time to discuss strategy. Is our strategy on track here? Are you on the mark with the strategy you're implementing?
We wrote the strategy, of course, 2 years ago. 2 years ago that got approval from the board. That was very much at the same time that we did our capital structure, and that commercial value proposition was needed really for capital structure. So we wrote that at quite a pace, but every year we review where we are. So when you look at the strategy and the ingoing assumptions, then on supply and demand, we predicted really supply issues and increasing demand, so demand outstripping supply. But if you look at our predictions at that time, two years ago, in our opinion, that would happen somewhere in 2017, 2018. So the world has moved much faster, right? We are now where we predicted to be in 2017, 18. So you need to review supply, demand, what's happening in milk pools, etc., etc. So we go through this review process. That doesn't mean that the strategy changes. The strategy is still very much applicable, but especially around our ingredients sales, we need to make sure that we deal with volatility, right? And that we make sure that in New Zealand we are going to fast track certain investments, yeah, that we really produce the products we want to produce and where we're good at, in an efficient way, that we drive the top line, because remember that top line, like this year, translates into payout, right? And at the moment we still have, what John said, quite a few legacy assets around the place, producing cheese, casein, so we have to make very clear choices and faster than expected. Yeah, but that's on ingredients. On brands, we are really we are really on strategy. Keep on turning the wheel, like we said. Keep on growing your volume despite volatility. And last but not least, we have a very clear approach on in which milk pools around the world do we want to be present. New Zealand is number one, very clear. We need to protect our share, but we also need to look at other milk pools. We can't ignore that. Europe is changing very fast. Latin America, like you said, is developing fast. Our China commitment to 1 billion litres of milk. So that's very important, access to milk.
Ian, we've heard a lot of talk today, we've heard a lot of figures and facts, but how do you think farmers will see this result?
Farmers will be happy. I mean, they're sitting on their best ever cash payout. So they've had a very good first half of the season. Production's been up, very, very good spring. Extra supplements made, so they have some flexibility in terms of milking into the autumn. There are some areas, though, that are impacted by the dry, absolutely no question about that. And there is, I guess, a couple of clouds on the horizon in terms of the latest GDT results. But, you know, we understand volatility, and we'll deal with it, as we always do, but positive, very, very happy with the $8 plus payout.
And I think farmers understand what we did here. There was we drove top line to the maximum, right? That produce maximum whole milk powder, sell maximum, and really drive the revenue line, which goes straight to payout.
That's right.
And of course, there is this effect of stream returns, the difference. We have handled that, but everybody understands that we did the right thing for the co-op.
Absolutely, and I mean, to our farmers, the key with Fonterra, the co-op, is the revenues go to them in their payout.
Theo, we were talking about milk price, but how do you close the gap? How do you make the most of the volatility of pricing differences between powders and other products?
The difference right now, or the difference over the first half, we have never seen that before. So it's really exceptional. But what I said in my strategic approach is we need to think really what assets do we want to have on ground, producing which products, Yeah, because we can't just rely on all our legacy assets like we did in the last years. Volatility has led to a situation where we really have to make choices, also in New Zealand. So we need to focus, of course, on the milk price products, but we're also investing quite strongly in food service, right? And that would mean that certain other assets, yeah, we might scale them down, or we might even stop them. And the assets which produce the right products for New Zealand and for the farmers and for the payout, we're going to fast track that, and that's how you close the gap.
So basically, are we expecting a new wave of investment?
We are definitely looking at fast-tracking certain investments which has a positive effect on turnover payout, but there's not going to be a huge incremental step up of capital. That's not going to happen, but we will fast-track certain investments in New Zealand, but also outside New Zealand.
It's also about bringing assets on a little bit earlier. So New Zealand milk growth is what the strategy that Theo talks about is just so fundamental to our cooperative. We've seen 2 to 3% milk growth historically, and we certainly believe we're still going to get that going forward. We've been able to provide a lot more flexibility to farmers through more flexible contracts, and farmers can share up over time. And that's been the good thing about the trading amongst farmers environment that we're now so solidly in.
Absolutely.
But if you think about what Theo is talking about, for the first time we're actually thinking about giving ourselves more flexibility at peak and bringing assets forward.
Another busy year for the co-op. In other words, John.
Every year's a busy year for the co-op these days, Scotty. But look, it's a good year for the co-op. It's great for our farmers to have such a strong payout looking forward. At the moment, though, as Ian's touched on and Theo talked about, there is a lot of volatility out there. We're seeing, like we as farmers in New Zealand, when the price is high, we tend to if we can, weather permitting, produce more milk, and we're seeing farmers around the world doing that. So it's going to be interesting seeing this dynamic between more milk coming in globally and how long the demand lasts and where the demand comes from. So we are expecting volatility, but certainly we're in a very strong place today.
Well,
and Scotty, also co-op, yeah, a very good year good for the co-op, but also very good for New Zealand. I mean, that flow of money, that revenue flow comes into the country and is being spent as well, right?
now it's a busy week coming up for you guys, not just a busy period for the co-op, but you're on the road meeting farmers over the next week, so there'll be talk about this in more detail.
As a board, we're certainly looking forward, and I know Theo and Lukas and the management team are very much looking forward to getting out and talking to our farmers. It's been a while, and I know our farmers have got a lot of questions for the board. And the things that we talked about today, why do we make those decisions around the milk price? What is the performance in our business? What is our strategy? And we've also got key executive coming in from our markets around the world who will also be there to present what's happening in their part of the world, what's happening in food service or in the consumer business, and just bringing that global perspective to the meetings around the countryside. I think we've got about 45 meetings. It'll be certainly very good to see our farmers coming along to these meetings. We fully appreciate it's a busy time of year at the moment, particularly with some of the dry conditions around the countryside. But for Ian and I, we really hope that our farmers can come along and participate.
Just want to reiterate the points that John's made, and also Lukas and Theo. It really is important. This is a really dynamic business that we're involved in, and the best way for farmers to understand that and to make change where needed is to attend the meetings, listen to the discussions and ask the questions.
Yeah, perfect, guys. It's been a pleasure. John, thank you. Theo, Lukas, Ian, thanks for your time, and thanks to you at home too for watching this Fonterra broadcast. Don't forget you can check the schedules for those meetings. They're up on Fence Post right now. Goodbye.